Hey guys, I hope you all are doing well. Welcome to the next episode of the Audit Practically series. Today, we are going to be seeing a very interesting financial statement line item, that is payroll cost. So, this is again an expense item in the profit and loss account. So, how is this presented in the profit and loss account? It is presented by the name of an item called employee benefit expense in the profit and loss account, and in the grouping, like when you go to the notes to accounts, it appears as salaries, wages, and bonus, contribution to provident and other funds, your salary-based payments, staff welfare expenses. And how do you arrive at the number for salaries, wages, and bonus, contribution to PF and other funds, SBP, and staff welfare expenses? It's basically based on your GL codes at your subgrouping level. Right? So, in case you're not aware of the concept of lead, grouping, and subgrouping, I've covered it in the first video of audit of operating expenses. You could just go in there, take a look, and come back here. You will have gold clarity. So, let's go into the financial statement line item payroll. So, first, what are salaries, wages, and bonus? So, salaries, wages, and bonus majorly comprise of the salaries you pay to your employees, the bonus you pay to your employees. Bonus could either be your joining bonus or your bonus based on performance or a statutory bonus. Anything will come here. Then your contribution to provident and other funds. So basically, your contribution to provident and other funds. Here the employer's contribution. Remember, guys, employee's contribution will not come here because employee's contribution will be a recovery from the employee. So whatever employer is giving out of his own hand will only come here, like your employer's contribution to provident fund, your employer's contribution to national pension scheme, your employer's contribution to superannuation fund. These items will come here, and your salary-based payments. So your salary-based payments will be based on your Ind AS 102 if it's an Ind AS client, or if it's an AS entity, it will be based on the guidance note for ESOP issued by ICA. Then your staff welfare expenses. Your staff welfare expenses will generally comprise of your catering expenses for your employees, the food expenses for your employees, the reimbursements which the employees have incurred and which they have requested for, which are claimed by the employees, the gifts which the employer gives to the employees. These will usually be sitting under your staff welfare expenses. And in the last video, just to give you a reminder, guys, we saw that we could select samples from the listing for operating expenses line item wise. But we can't do that in case of payroll. The reason is because, let's say you have 100 employees in a company, and let's say your employee cost is rupees 100. The entry you will be passing is employee benefit expenses account debit 100 to your employee benefits payable 100, then your employee benefits payable account debit 100 to your bank 100, assuming that your gross pay and net pay is the same, which is a very unrealistic scenario, but just for the purpose of simplicity, we are assuming this. So in such a scenario, what will happen is that when you look at your journal dump, or when you look at your GL dump or your listing, it will be one single entry. It won't be employee based. Like we won't know as to what is the gross pay for employee 1, what is the cost for employee 2, what is the cost for employee 3. So we make the use of a report which is maintained by the payroll team or your HR team, which is called your pay register. So this is the reason why your pay register is relevant, because your pay register will contain employee-wise details, component-wise details, and your pay-wise details, and how it is subdivided into. So it is a more detailed report, and so that is the reason why we will rely on pay register as a report. So guys, so we know that. So what we will try to be doing here is, we know that, let's say the amount of your gross pay as your pay register, as per your pay register, is rupees 100, but the pay as per your salaries, wages, and bonus is rupees 80. This is not an exception. There might be certain reconciling items which we will look into later. So what is gross pay and why is it important? So we will look at this. So gross pay is basically the amount which the company incurs as an expense towards the employees, which will basically, most of the components of gross pay, like if I have to put it in perspective, 90% of the components, just a second. So if I have to give a perspective, 90% of the components of gross pay, just a second, guys, just give me a moment. Yeah, so if I have to give a perspective, 90% of the components of gross pay will be linked to your salaries, wages, and bonus. So gross pay is basically your sum total of certain components like your basic pay, HRA, LTA, education allowance, telephone reimbursement, your special allowance, fuel reimbursement, your leave encashment. Like basically, if you're an employee of a company, you will have an option in your companies to encash the leave balance you have. So we will go into the concept of leaves later on as a part of audit of benefits in the Audit Practically series. Let's not deep dive into that right now. Then you will have your bonus or incentive. Then you will have a commission. So like if you're a part of the sales team, you'll have a sales commission. And let's say you also have overtime allowance which might be there if you work overtime beyond your stipulated work hours. Then you have gifts to your employees. So these components will form part of gross pay. Then there are deductions. So what are deductions? So deductions are basically recoveries from the employee. So why recovery? So let's say, just a moment. So above, we were discussing about employer's contribution to provident and other funds, right? So here there will also be an equivalent employee contribution. Let's take the example of PF. So here the gross pay for an employee, let's say, is rupees 100, and let's say the deductions are 20. Let's say the entire deduction is arising out of employee's contribution towards PF to the extent of 20. So what will be the journal entry we pass in this case? Like the expense is 100, and what will be the journal entry we'll pass in this case? Because this will help you get clarity on how deductions are accounted and how you arrive at your net pay. So this will give you better clarity. So let's assume that the only deduction is PF for the purpose of simplicity. So the entry we will be passing is employee benefit expense account debit 100, because that is actually the company's expense. Then your bank to the extent of 80. Then your, just a moment. Then your PF payable to the extent of 20. So why PF payable? Because this amount is the amount which is the employee's contribution, but the company has a liability to deposit it with the government, which is why PF payable is that to the extent of 20 rupees, which is why it is a liability case. So I hope you understood this. So I think in this case, if I have to give you a perspective, this is the gross pay. So this is the net pay, and this is the deduction. So deductions are basically any recoveries from your gross pay. So deductions are items that basically reduce your gross pay and make it into a lesser number. And ultimately, the lesser number which the gross pay is turning into is your net pay. So I think this is how I can simply probably explain this. So like I've summarized it below here, saying gross pay is the amount that is booked as an expense, and your net pay is the amount that is ultimately paid to the employee, like the amount which gets credited to your account every month. That is your net pay. So maybe I will also explain separately on what is the difference between CTC, what is the difference between gross pay and CTC, why is your CTC more than your gross pay? Like we will have that as a separate discussion. It's not very relevant in the present context, but again, I'll take it up separately. And next, so payroll versus real reconciliation. Why do we need to do that, and what is that? Is, as I told you earlier, so most of your gross pay components will be forming part of your salaries, wages, and bonus here. But some components might not be there in salaries, wages, and bonus. Some components might go to your staff welfare expenses also. That is also a possibility. And so we need to understand that the number which we are taking as a gross pay in the pay register is complete. So why do we need to get this comfort base? Because we are selecting samples, we are doing all our testing out of our pay register. Because as I explained earlier, in your journal dump, it will only be a single entry. It won't be employee-based. So we need to rely on a report which is maintained by the payroll team, which is the pay register. So we need to get comfort on the completeness of the pay register, which is why we do something called as payroll versus real reconciliation. So what do we have to ensure? Like we have to, as I told you, since 90% of what is there as a gross pay in pay register will go to salaries, wages, and bonus, we need to ensure whether the total of salaries, wages, and bonus is perfectly matching with the gross pay as per pay register. But it might not match. There are certain reconciling items or reasons due to which it might not match. This is again similar to your BRS. Like you need to reconcile it. Like I had also explained a similar concept in effective tax. Ultimately, everything is a reconciliation. Nothing is an exception. There are reasons for difference due to the basis in which the entries are passed, etc. So if I just come down here, so there are certain items which are the reasons. So if I have to give you an example, bonus, leave encashment, gift payment to employees. So earlier I told you about bonus. So bonus. So pay register is ultimately gross pay minus your deductions, which is equal to net pay. In your pay register, what goes inside is on cash basis. So let's say there is a bonus which goes inside as rupees 100 in your pay register. In your salaries, wages, and bonus, that number need not be 100. The reason being, in your salaries, wages, and bonus, your bonus provision which you create during the year, that is basically the entry which you pass as expense account debit to provision for bonus will only be accounted there. But in your pay register, the entry that will be coming inside your pay register is basically your provision for bonus account debit to bank. So that is the entry that will be coming inside your pay register. So pay register, if I have to put it in simple words, it will be on a cash basis of accounting. But your books of accounts, your salaries, wages, and bonus grouping will be based on your accrual basis of accounting. So that is the difference. And another difference, and a similar concept is applicable for leave encashment. For leave also, you will accrue your leaves. You will accrue a P&L charge for leave. And there will also be a payout in relation to leave. So in your pay register, the actual amount that is paid will be coming. But in your GL, your accrual will be coming because that is the expense hit that you're taking. So that is another difference. And payment to employees. So you might have a doubt. So payment to employees. So in 99% of your cases, whatever gift you give to your employees, you will accrue it at the time of giving the gift. So there won't be any timing difference between accrual and payment. So why is this a reconciling item? Yes, just go back a bit in time. I explained to you as to what probably would come under staff welfare expenses. So one of the items which I explained to you was gift given to employees. So when you're comparing your pay register with your salaries, wages, and bonus, your gift given to employees will form part of the gross pay in your pay register, but it won't be there in your salaries, wages, and bonus. So let us say we start with a let's say we start with the gross pay as per our pay register. So when we start with the gross pay as our pay register and try to arrive at the salaries, wages, and bonus number, how do we treat these items? So let's go to this. So we will add back the bonus and leave P&L charge because this is ideally what will be there in the GL. But remember, to the extent of the amount that has been already paid, it is there in the pay register. So we will remove the amount that is already paid via the pay register because it is ideally not an expense component. It is a payment of provision that is created earlier. So we will remove this. And similarly, your gift given to employees will be grouped under your staff welfare expenses. So it won't be there in the salaries, wages, and bonus number which we are trying to derive. So we will reduce it while arriving at the P&L charge for salaries, wages, and bonus. Then we will derive the salaries, wages, and bonus number. We will compare it with the salaries, wages, and bonus number which is there in the grouping. We will see if there are any further reconciling items and we will understand. Which are the reconciling items? This is again a very, very illustrative and very basic list of reconciling items that are given because there can be multiple reconciling items. I did not want to go too deep into the concepts, which is why I just gave a few very, very regular reconciling items. So maybe what will happen is, if I have to just go up, I just explained these components of gross pay. Let's say, so what will happen is each of these components of gross pay will be assigned a pay code. Like for example, let's say your basic here will be assigned a pay code of example XYZ. Your HRA will be assigned a pay code of ABC. So what will happen is any accounting software or any ERP will be configured in such a manner that your basic component here directly hits GL code 58000. Your HRA will be configured in such a manner that it hits the GL code 58001. So through this manner, you will be able to understand as to which of the components of the pay register are going into your salaries, wages, and bonus, which is going into staff welfare. Sometimes there might also be a case that it might be going into operating expenses. Some of the components might be grouped under your operating expenses in your financial statements. So this mapping of the pay codes to the mapping of the pay codes in your pay register to your GL codes in your financial statements will help you to do your payroll versus GL reconciliation in an even more hassle-free manner. And you can also find if there are any additional reconciling items which you have missed, which the client will obviously plot and give to you. You can compare that with what you've done. You can see if you've got any differences between what is the derived salaries, wages, and bonus number versus what is actually there in the grouping. And this will help you get a comfort over the fact that, okay, whatever number we are taking as cross pay in the pay register is complete. It is complete to the best of our knowledge. Now we have to test the accuracy of it. So to test the accuracy part of it, we will go into in-depth testing. So again, this is basically the bonus and leave encashment movement which I just explained verbally. Maybe you can just see it now. It's the same thing which I said. Maybe in case you have a doubt, you can just pause the screen, look at this. This is a bit self-explanatory. So next I just come down to my in-depth testing. So in-depth testing, we will just come back like basically where we will trace the gross pay of the employee back to some documents. I will just explain that. In the meanwhile, we'll just look at something simple, something which is chill, pay register variance. So as I told you, we will have the gross pay. One of the components of gross pay is your basic salary. So what we will do is month on month, we will try to see a variance between how much is our basic salary, how much is the basic salary moved, how much is the gross pay moved, what is the percentage of movement, what is the reason for the variance, and we will do it at an average level. So by an average level, what I mean is basically you will know the headcount for each of the months. Like you will know how many employees are there in April, how many are there in May, how many are there in June, and so on and so forth till March, your closing period. So what you will basically do is like, let's say April and May are there. So to arrive at your variance, what you will do is, you know your gross pay, you know your headcount. So you will derive your gross pay per headcount and you will see how much percentage is the variance between month on month. Similarly, you will do this for at the basic salary level also. You will do both these variances to get a comfort of how the payroll is moving, how the variances are moving and stuff. So this will help you get a better perspective on this. So this is that. So basically you'll understand reasons from the client, from the payroll and the HR team as to why that's moved. Sometimes there might be a salary escalation. due to which there has been a significant movement in your gross pay in 1 month as against the previous month. Sometimes what might happen is there might be a bonus payout in a particular month which might not have been in the previous months. Sometimes there might be a fuel reimbursement processing cycle which might be at the end of the quarter, which might not have been there in the last 2 months, which might lead to an increase. Or sometimes there might be a restructuring in the operation in 1 month, due to which there might be a significant variance. So these are some of the reasons which I had probably given you. Or there might be a drastic change in headcount also in one of the months, due to which the average is getting affected. So you can understand these reasons from the client. You can investigate significant variances, get a perspective of them, and proceed further. So that is one thing. And headcount reconciliation. So headcount reconciliation, this is a very overlooked concept. People think this to be very simple, but again, this is some area in which you have to apply your mind again. So if I have to give you a perspective, what is a headcount reconciliation? You know how many employees were there at the start of the year. You know how many employees joined in a particular month. You know how many employees left in a particular month. So sorry, I missed out the deletions here. And you know how many employees came in as transferring, how many employees went as transfer out. So to give an example of transferring, like let's say Tata Group is a very big group. So like let's say a person moves from Tata Steels to Tata Motors. He might be a transfer in Tata Motors, and he might be a transfer out from Tata Steel. So this is the concept of transfer in and transfer out. So why are we segregating transfer in and transfer out? So what they do is, let's say you take a group like Tata. Let's say an employee joins Tata Steel on, let's say, 1st April of 2010. Let's say he comes to Tata Motors, let's say on 1st April 2017. So what will happen is, when he comes to Tata Motors, his joining date will still be 1st April 2010. It won't be 1st April 2017. Because for the employee to get benefit in relation to gratuity, because your gratuity is based on your basic, your companies tend to keep your joining date in the new company also based on the first day on which you join one of the group companies. So this is what some of the groups do to give benefit to the employees. So this is one thing. And in relation to headcount reconciliation, we take the opening, we take the additions, we add the transference, we reduce the deletions, we reduce the transfers, and arrive at the closing. And we compare this with the closing headcount as per pay register. But there might be some reconciling items. Why is that? Just lend an ear to me. I will explain that to you. So payroll cutoff date. So there is a concept called payroll cutoff date in some companies. So for example, let's say a company processes pay on the 29th of every month. And the employees who join only on or before 28th of that month will be entitled for pay in that month. So let's say Mr. A joins on April 29th. The pay for the 2 days in April will be processed as arrears in May. So the employee would not be there in April pay register, even though he joined in April. So when we are taking him as an addition in our headcount reconciliation, he will not be that, but he will not be there in the April pay register. He will get added only in May. So these are reconciling items, and we need to understand the reasons for any difference which we derive as the headcount as per the derived moment versus the headcount which is actually there in the pay register. And at the end of the year, we need to ensure that the employees who actually been added have also been included for the pay processing. Because what might happen is, let's say an employee joins on 28th, let's say an employee joins on 29th of March 2024, let's say the financial year ending is 23-24. So the pay for the 2 days might be processed somewhere in April as arrears along with the pay for April 2024. You might be thinking that this is not going to be a material impact because it's only 2 days of pay. But what might be the problem is that, let's say the employee is a very highly qualified employee. Let's say he's like a chief technical officer in the company. He might be earning a big paycheck. He might be earning a big fat paycheck. So even when you proportionate it to 2 days, it might be a huge amount. So you might have to tell the management to accrue the amount to that extent, because he might not be there in the pay cycle. But you would need to accrue it for the purpose of your financials, because your Schedule 3 financials are based on accrual basis, right? So that is one thing where your headcount reconciliation definitely comes into play. And similarly, let's look at a deletion example. So let's say the employee leaves on April 29th, but the company might have him in April pay register and remove in May. So we need to check if these are reviewed appropriately and are in line with the policy, and ensure that the employees who joined in the financial year March 2024 are sent to the actuary, even if they joined after processing for March. Like as I told in the example, let's say someone joins on March 29th, 2024. So for actuarial valuation, so we will discuss about what actuarial valuation is. So it is basically the future estimation of the gratuity and leave liability for the employees. You accrue the P&L charge now itself. So in such a case, even though the employee is not there in the pay register, he is an employee of the company. And as on March 31, 2024, the period ends. So he needs to be sent to the accident. And his cost also needs to be accrued. The company giving a reason saying that sir, he is not there in the pay register, so we did not accrue the cost for him, is not a valid contention, because your books of accounts are based on accrual basis and your pay register is based on pay basis, and it is an administrative register and it is not an accounting register. So you need to be aware of that and you need to be cautious about this, because it might be a material impact if the accrual is not done for an employee who earns a big fat paycheck. So that is one thing which I wanted to clarify. Net pay tracing. So net pay basically, which I explained, is your gross pay minus your deductions is equal to net pay. So your net pay will be appearing as a column in your pay register. So what you will actually do is you will see, let's say your net pay is 80, you will go to your bank statement and see if the company's bank account has been debited to the extent of 80. But there might be cases where the net pay might not be 80. It might be a higher number or a lower number. There might be reasons for this, which we will discuss. Again, this is again reconciliation. I know we are seeing a lot of reconciliations, but I am making you aware of the practical scenarios as well, so that you are ready to face the real world to a decent extent when you step into the field of audit. So yes, so first we look at the net pay at the aggregate level, then at an employee level for samples. What do I mean by employee level? Because you might have this doubt, because like let's say the total net pay for the company is rupees 80, only the debit of 80 will be appearing in the bank statement. It won't be appearing employee wise, right? You might ask me, how can I check employee wise? So you have a concept called master file. So let's say there are 100 employees in a company. So what the company will do is, let's say the company makes the net pay payment through HDFC Bank. So the company will submit a list of the employees for whom the net pay is to be made. Submit a list of employees for whom the net pay is to be made, along with their account details, where they hold an account, along with their other credentials, for the bank to make the payment in batches. So you can get the Excel file which the company has uploaded on the bank portal for the bank to make the payment, and you can see at an individual employee level also for sample cases as to whether the net pay as per pay register is tying out to what has been actually processed to the employee. So this will again give you a comfort that even at the individual level it is fine, and even at the aggregate level it is fine, and you can move on in life. So next, talking about the reconciliation which I mentioned above. So let's say we start with the net pay as per pay register. How do we reconcile it to the net pay as per bank statement? So let's say you have a net pay as per your pay register. You reduce your whole payments for which pay won't be disbursed. So what are whole payments case? So sometimes what might be the case is that the employee might have worked the full month, he might be entitled for the pay, but some companies have a policy wherein you need to fill your timesheet for the pay to be disbursed. Let's say you do not fill your timesheet. Let's say the pay as per the pay register is 80. Let's say there's an employee who is getting a net pay of 10 who is not filled his pay sheet. So what the company might do is the company might not disburse the net pay for him for the month of March. They will do it only in the subsequent month of April. So for the month of March, your net pay as per your pay register might be 80, but the net pay as per the bank statement would be 70. It would not be 80. This would be a reconciling item. So you would need to go back. You would need to see whether the reason for it is whole payment and whether the reason is justified enough, and whether it is subsequently gotten processed in April or not. So that is something you might be required to see. And your next would be your recoverable from employees. So what is this concept is? So let us say there are some employees from whom there is a recoverable amount. So let us say that an employee was on leave for a decent number of days in the month, but there are deductions for the employee. Let's say there is an advance recovery, there is a loan recovery from the employee which is going on month. Let's say the gross pay for him is 8, but he's taken a large amount of medical advance due to an emergency, and the medical advance is recovered as a part of pay. So what might happen is, in some cases, you might have a receivable balance from the employee instead of having a payable balance towards the employee. This is the case. So what will happen is, then you will have a receivable balance from the employee to this extent. Let us say you have other employees in the company for whom the net pay is, let's say rupees. Let's say the net pay is rupees 1. Let's say you take this to be crores or lakhs, whatever it is, guys. So what will happen is, in the pay register for the particular month, the recoverable balance from the employee will be shown as rupees 1. But you might be able to see that in your net pay as per your bank statement, it is rupees 1. You might go and ask the client, sir, for the month of March, you have a recoverable to the extent of rupees 1, but you have actually paid rupees 1 to the employees. How is that possible? Guys, this is where you need to think logically. For one of the employees, there was a high recoverable balance, which was offsetting the payable balance to the other employees. So for the other employees, the payable balance is 1, which was paid through bank statement. So what you will do in this reconciliation is, you will basically add back the two while arriving at the reconciliation. Because what would happen is, your pay register would be a receivable number, but your bank statement would be a payable number. So to arrive at your higher number which is there in your bank statement, which has been debited in your account, you will add the differential and arrive at your net pay as per your bank statement. That is that. And next, your F&F. So let's say we are looking at financial year 23-24. Let's say there was an employee who left in March 2023. So for time, it would take time to complete the exit formalities. Let's say the exit formalities are completed somewhere in April of 2023. So April 2023 falls in financial year 23-24, and let's say the pay for March is disbursed in April to that employee. So when you're looking at the line item for your net pay tracing for April 2023, you will need to reduce this because this will not be there as a net pay in your April 2023 pay register. So to that extent, your April 2023 pay register would be higher. So you will need to reduce that. You will need to reduce that while arriving at the net pay as per your bank statement. So this is something which you need to do, guys. Sorry, it's just a small mistake. So let's say I was talking about the example where the employee left in March for whom the net pay would be disbursed in April. So what would happen is the net pay component would not be there in the March pay register, but the net pay would be debited to the company's bank account in April 2023. So what would happen is your pay register would be lower to that extent of net pay, while your bank statement would be higher to the extent of that net pay. So what would happen is you would add that to arrive at the net pay as per your bank statement because the net pay is getting disbursed only in the month of April. So it will be a plus and not a minus, guys. So forgive me for the explanation. So yeah, so that is what it is. And in-depth validation. So in-depth validation, we will be basically seeing on what we do for employee additions and employee deletions and employee existing. So yes, so we will be looking at in-depth validation, which is one of the concepts. We will be looking at statutory dues like PF, your professional tax, ESI, NPS, staff welfare expenses, and your bonus and your Caro reporting implications also as a part of the next video. So stay tuned, subscribe to the channel. Next video is going to be out soon, guys. Take care. Bye. Cheers. Good day. Thanks.